Please be interactive. So it's about acquisition. Can you all tell me what is acquisition? Can you all tell me what is acquisition? And who can acquire?
It's when one firm takes over the other firm.
So when you're talking about firm, will you talk about firm acquiring or a limited company acquiring?
Limited company.
Okay, so acquisition is when the old firms completely lose their identity. Okay, they don't have any identity, and this can happen only in case of limited companies because limited companies have independent identity. Do you agree with this?
Yes.
Okay. So when I'm talking about acquisition, acquisition is always when the limited company is taking over some other companies. So the limited company can either take over a sole trader, and the limited company can also take over a partnership firm. So when a limited company is taking over a sole trader, it is just as simple as a merger. So those type of questions will never come in your exam. But when a limited company is taking over a partnership firm, in that case, you should know that the partnership firm is going to dissolve. So when I say that the partnership firm is going to get dissolved, that means everything of the partnership will go away. It will be acquired by the limited company. Even this is not difficult. But there is only one thing which is different in acquisition when the limited company acquires a partnership is when the partner has given any loan to the company. So tell me what happens when a partner gives loan to the firm. Tell me
Partner
what
gets
happens
interest from
when a partner gives loan to the firm.
partner gets interest from the company.
The partner will get interest from the company. And if the partner gets interest from the company, what happens? If the partner gets interest, what happens? It is an expense for the firm, right? When the partner
Yes.
is getting interest, it is basically an expense for the firm. Now, what happens over here is that the limited company is going to acquire the partnership firm. And the limited company cannot have any liability in the name of loan to partners. Limited company cannot have any liability in the name of loan to partners. So in that case, this loan to partners has to get converted into percentage debentures. And this is the only thing which is different in case of acquisition. The loan to partners has to get converted into percentage debentures in such a way that the amount of interest would remain the same. What would remain the same? Amount of interest would remain the same. So first thing, when a limited company acquires the partnership, everything of the partnership will go to limited company, it is going to dissolve. But one thing of the partnership cannot go to limited company. What is it? One thing of the partnership that cannot go to the limited company is what?
Partners to loan.
Partners.
Loan to partners.
Yeah, loan to partners. So this loan to partners has to be converted into percentage debentures. That means the limited company is going to give the partners instead of loan, the loan will get wiped off and it will be converted into percentage debentures. But the debentures should be issued in such a way that the amount of interest remains the same. So maybe partner's loan is at 6%, but I want to issue debentures which is 10% debentures. So the number of debentures should be issued in such a way that the amount of interest remains the same. Okay, I want you to read this situation number 1 and tell me what is happening over here.
Are the debentures?
Yes, tell me.
Why are the debentures issued on the interest?
No. Listen. Partner has given loan to the company 50,000, right?
Mm-hmm.
Okay. That means the company, and it is at the interest of 6%. It means that the company has to give partner 6% interest. Yes? 6% interest on 50,000 is 3,000. 6% interest on that loan is how much? 50,000 is what? 3,000. Yeah.
Yeah.
Now the limited company has to give 10% debentures, but they do not want to change the amount of interest. They want the amount of interest to remain the same. That means even if they are going to give 10, 15, 20% debentures, the amount of interest will have to be 3,000. So they are asking now how many debentures should we issue so that the interest should remain 3,000. So we want to find out what would be the value of debentures that we can issue. So now if you see the value of debentures that you can issue, I want the interest to be 3,000 at all. 3,000 divided by the percentage, that means you can issue debentures of 30,000 so that the value of the interest would remain the same. Think properly.
Yes, Miss, got it.
Got
Makes
it?
sense.
Okay.
Yeah.
So if it was 15%, then what would be the value of the debentures that you can issue? So that the interest would
20,000.
be the same. If it is
20,000.
15%, so 3,000 divided by 15%, so it would be how much?
20,000.
It would be 20,000. So here the only thing is that loan has to be replaced with debentures. But the percentage of the loan and the percentage of debentures are different. So you have to find out what 10% or 20% debentures you issue so that the amount of interest expense remains the same. Are you with me? So when there is an acquisition,
Yes, miss.
acquisition of what by whom?
Acquisition of a partnership.
Acquisition of a partnership by a limited company, there would be one thing that you would have to do. What is that one thing?
Change loan to debentures.
Change loan to debentures. And you will change this loan to debentures in what way?
And while keeping the amount of interest paid the same.
By keeping the amount of interest paid the same. And how will you do it? Can you give me the steps to do it?
So you will divide the amount
First,
that
find the
currently getting.
interest on loan. Okay. Then
And then divide the interest on loan by the percentage rate that on debentures that the
find
company is
the
giving.
interest on loan by the percentage rate that of debentures you will have to issue. So what will you get? What will you get?
The value of interest.
You will get the value of debentures to be issued. What will you get? Can you please repeat?
Value of debentures to be issued.
So that what remains the same?
The interest paid.
So that the interest amount remains the same. Are you with me? I will give you
Yes,
one
please.
illustration. You can go ahead and try this situation too. You all can try this situation too.
So Miss, the limited company, instead of paying, like here in this case, instead of paying the full 80,000, they'll only repay 40,000.
No. they are going to take it, okay? And they are going to give interest to the partners. So that interest amount should remain the same. And yes, they take over it at a lower value. That depends, okay? Here they want only that the interest amount should remain the same and the partner will never convert those debentures into taking that amount.
Okay.
Okay. Because whenever there is a takeover, you can take over the assets or liabilities at a higher value or at a lower value. It depends upon the agreement. Now I want you to try this. I'm highlighting all those important things that you would need. Are you all done?
Yes, Miss.
Okay, Rupinder. So can you tell me what's happening over here?
I can tell you how to do it.
No, you have to tell me what's happening. Okay, come on, tell me how to do it.
Okay, so the interest on loan is 4,000.
Which loan? Who has given to whom?
The partner to the company.
Okay.
That is 4,000.
Hmm.
And debentures to be issued so that the interest rate, the interest would remain the same, which is 4,000, is 40,000, which is 4,000 divided by 10%, which is the percentage given for debentures.
Okay, stop. So Farha, your question was that instead of 80,000, the debentures value would reduce by 40,000.
Yeah.
Yes, it happens. The debentures, the loan will get converted into debentures. The loan was of 80,000, but now the debentures will be of 40,000. So there is a 40,000 loss. But our purpose is that the interest amount should remain the same. We'll go ahead.
Okay.
Can we
Miss,
go
it's
ahead? Yeah, tell
Miss,
me.
I have a so we
Tell me.
even if there is a loss while making the debentures go from 80,000 to 40,000 instead of just paying the partners more interest.
See, when the assets and liabilities are taken over, they are already being given an agreed value. Okay, so now that arrangement we are not entering into. We are just looking at the accounting treatment. The agreed value is being decided between the firm and the limited company. So now this partner wants to have the same amount of interest. He is not concerned about anything else. So when there is an acquisition of the partnership firm by the limited company, the first thing that happens is that the partnership firm has to close down. So maybe you will have some liabilities over here of the partnership firm and you will have some assets over here of partnership firm. So partners can have their capital account, partners can have their current account, partners can have liabilities. I'm putting one more thing over here, that would be the partner's loan. Then afterwards they will have all non-current assets, they will have current assets. Now what is happening is that the partnership is closing down. When I'm saying that the partnership is closing down, that means that the partnership is dissolving. Partnership is closing, partnership is dissolving. That means everything of this must go away. So where does it go away? We prepare two accounts when I do acquisition. The first account that I will prepare will be a realization account. And the second account that I will prepare would be partner's capital account. Understand one thing, everything that is there on the liability will go somewhere to the credit side. And everything that is there on the assets will go somewhere to the debit side. And you have to shut this balance sheet because it is not going to be existent in any way. Now this entire partnership firm will become an independent limited company. So what do? Whatever is the partner's capital and current account balances, you will transfer it to partner's capital and current account, whichever side they belong to. Okay? Are you with me?
Yes, miss.
You have to close the old balance sheet. So first thing that you would do is you will remove the current account by transferring the balances to the capital current account wherever it is. Second thing that you have to do is you have to deal with the loan from partners. How will you deal with the loan from partners? Can you please tell me?
You'll change to debentures.
Percentage debentures in such a way that
The partners receive the same amount of interest.
the partners receive the same amount of interest. Then the third thing that you would do is you will make a realization account. So when you make a realization account, all the assets would go to the debit of the realization account. Okay? All the liabilities will go to the, except for the capital current account and the partner's loan, all the other liabilities would go to the credit of the realization account. Can you all tell me what is realization? Can you tell me what is realization? Okay. So realization is basically an account which tells you at what value your assets and liabilities are taken over. So the limited company will have all the assets transferred over here and all the liabilities over here. So after the assets and liabilities, that agreed value that is decided, the limited company is going to pay the partnership something which is called the purchase consideration. And in the realization account on the credit side, you will get purchase consideration. What is purchase consideration? Purchase consideration is, yeah, tell me.
It's the amount the limited company will pay as a result of the takeover.
It is the amount that the limited company will pay to the firm for taking over their assets and liabilities. If they have paid a more amount, you will get a profit on realization, which would come over here. And this profit on realization belongs to the partners. Okay? And if they have paid a less amount, you will get a loss on realization. Even that will be distributed to the partners. Are you with me? If it is a
Yes,
profit
miss.
on realization, it is debit over here and credit over here. And loss on realization, you will never face a situation. But in case if they give, you should know the effects of it. Okay?
Miss, the difference is the goodwill, right?
Difference is goodwill. That is what I said. There will never be a loss on realization.
Okay.
Okay? After that, you will also have to close the partner's capital account. The partner's capital account will not have any balances. Whatever is the balancing figure, be it on the debit side or be it on the credit side, whatever is the balancing figure will be settled through payment of cash or bank. We will do a sum wherein all your doubts will get clarified. So partners' capital account will never be reflected. Partners will be given debentures and their account will be finally settled. Either you take money from the partners or you will give the money to the partners. Purchase consideration would be given to them. debentures would be given to the partners, and the capital account, whatever balance that they have, will be settled in cash or bank. Are you with me?
Yes,
Are
miss.
you with me? So what are the 5 steps for acquisition? Can you tell me?
First, you
Removing the
find
credit.
the. Okay.
Yeah, tell me. Farha, can you tell me?
First step is removing the current account balances.
Okay, if the
By
current
transferring
account balance is on the debit side, where will you put it?
on the credit side.
On the debit side. And if the
Oh, no,
current
no, it's on
account
the debit
balance is
side.
on the credit, then where will you put it?
On the credit side.
Okay, fine. So first is you will get rid of the capital and current account balances and put everything in the capital account. What is the second step? Arish, can you tell me?
The loan to partners would be converted.
You will the loan from partners. So you will calculate the interest that's already
Partners
been
loan
paid,
will be converted to
and
percentage debentures. Partners loan will be
interest,
converted
yeah,
to
and then you will pay the
percentage
same amount.
debentures. Yeah. Then what is the third step?
Realization account.
You will prepare the realization account. How will you prepare the realization account?
Miss, ask Upinder.
Upinder,
Okay, the assets on the debit side, liabilities on the credit, and the difference. Why are you looking at? Okay.
and they will give you the purchase consideration. Okay. The purchase consideration would be on the credit side. Okay.
Okay.
Then what will you get? Sidra?
Yes, miss.
Then what will you get?
What will you get? The realization profit.
Okay. Where will it be?
Okay, where will you'll transfer it to the partners capital account and share it amongst the partners
Okay.
on the credit.
Okay, no problem. Farha, then what will happen with the partner's capital account? What will you identify in the partner's capital account?
The amount that is either to be paid to the partners or partners will pay the
Will
limited
there be any
company.
situation that the partners will have to pay or the partners are going to take away?
It will be mostly the partners taking, right?
It will be mostly the partners taking away because they are dissolving their partnership. Okay. After that, what will you do? You will make the necessary entries in the ledger so that you can record the partners receiving the share, and then you will find out your new bank balance. Now, in most of the questions, they will ask you for 5 or 6 marks, the journal entry that you have to pass for taking over. So when the limited company is taking over the partnership firm, they will ask you to pass a journal entry. So this is the journal entry for takeover of of partnership firm by a limited company. So first thing, all assets that are taken over, you will debit it at the book value. Okay. All liabilities that are taken over, you will credit it, and the purchase consideration. Now, what will be the wholly out? What will be the purchase consideration? The limited company can.
Yes, Miss, let's start.
So the journal entry for takeover would be all assets that are taken over debit, all liabilities that are taken over credit. I'll repeat the journal entry for takeover. What will it be? All assets taken over debit, all liabilities taken over credit. Yeah.
Yes,
Assets
ma'am.
taken over debit, liabilities taken over credit. Apart from this, the limited company is going to give the partners purchase consideration. Now I'm using these words, please be mindful. The purchase consideration will not always be the cash that they are giving to the partnership partners. They will give them shares. Maybe the shares are given to them at premium. So in that case, you will credit the share capital, you will credit the share premium, whatever money that they are giving in cash or bank, that you will credit, and the debentures that they are giving. So the purchase consideration is discharged by giving them shares. Shares can be issued at premium, money can be given, percentage debentures can be given, and this will be given in the question. Are you with me? Assets taken over debit, liabilities taken over credit, and the purchase consideration that is discharged. The amount which the limited company, this purchase consideration is the amount at which the limited company is going to buy the partnership. Are you with me?
Yes,
Yes,
miss.
ma'am.
Okay. Difference between the assets and liabilities taken over is called what? Assets taken over minus
Goodwill.
liabilities taken over is called what?
Net asset.
It is called NATO. Net assets taken over. You will compare the NATO with the purchase consideration. Now, if you see over here, assets minus liabilities, and you have the purchase consideration also over here. So the difference between the NATO and purchase consideration will become what?
Goodwill.
Difference between the NATO and purchase consideration will become goodwill. Either you can find it like this and you have your goodwill amount known prior hand, or you can find it as a balancing figure over here. So I want you to write the journal entry for taking over the business. So what is
All
the journal
assets,
entry for takeover?
all assets debit, all liabilities credit. Purchase consideration is also credit, and the purchase consideration will be made up of share capital, share premium, all of that will also be credit. And the difference between the net assets taken over and purchase consideration will give you the goodwill.
Okay, fine, no problem. So we are going with the first thing. They want us to record the journal entry for the purchase of the business. Now, if they want us to record the journal entry for purchase of the business, can you tell me how will the journal entry look like? Can you tell me how will the journal entry look like? All assets?
Or
Yeah,
debit.
hmm.
Or assets debit or liabilities credit.
Hmm.
Purchase consideration credit, and the difference will be goodwill.
Okay, fine, no problem. So now this is a sole trader on 1st October whose statement of financial position is given to me. Now, can you tell me if a sole trader statement of financial position is given to you, will there be any percentage debentures that would be issued to the sole trader in lieu of loan?
No.
No, very good. So I have some non-current assets. I have current assets. I have his capital and I have his liability. The net assets were taken over at the following values. So I have the values of the net assets that is taken over as well. Okay. What are they asking me to do? The total of the agreed value of the assets purchased amounted to 366,000. So can you tell me what is 366,000? What is
The total.
366,000?
Yeah, so taken over, I think.
NATO
The net
or purchase consideration?
NATO.
It is the NATO. It is the net assets taken over. Lakfil did not take Muhammad's cash and cash equivalent. He has not taken his cash and cash equivalent. So these are not entered in the journal. Lakfil has paid Muhammad 500,000. Can you tell me what is 500,000?
Purchase consideration.
Yeah.
Purchase consideration. So purchase consideration is 500,000. NATO is how much?
366.
So can you tell me what will be goodwill?
134.
So goodwill will be $134,000. Can you also tell me how is the purchase consideration discharged?
So the cash is $100,000 and 250,000 ordinary shares of $1 each.
So ordinary share capital is 250,000, but the purchase consideration is 500,000.
There's a premium.
Purchase consideration is 500,000 and they have given us information only of 350,000. So what is the
Yeah.
There's a premium of 150,000.
Sorry?
There's a premium of 150,000.
Yes, so there is a premium of 150,000. So can you tell me the breakup of the discharge of purchase consideration? Or the breakup of the issue of shares? How many shares are issued?
250,000 ordinary shares at $1.50.
Of $1.50 are issued at premium. What is the premium amount? So the premium, the total premium is 150,000. 150,000 I am going to get from 250,000 shares. So can I say 150,000 divided by 250,000? So the premium is 0.60 per share. Yes.
Miss, can you repeat that?
Extra is for premium, $150,000. Yeah. That means the shares are issued at a premium.
Yes, miss.
Purchase consideration is discharged for cash 100,000 and they're giving ordinary share capital of 250,000. That is 250,000 shares of one each. Are you with me?
Yes, miss.
So total purchase consideration is 500,000. It means that the ordinary shares are issued at a premium. And the premium is 150,000.
Okay.
This 150,000 I am going to get from how many shares?
250.
I'm going to get from 250,000 shares. So can you tell me the amount of premium per share?
0.6.
0.6. So can we say that 250,000 ordinary shares of one each is issued at a premium of 0.60 per share?
Can you
we say
repeat that?
Can I say that 250,000 ordinary shares of one each is issued at a premium of 0.60 per share?
Yes.
Yes. You can check 0.60 into 150,000, sorry, into 250,000 would give you a premium of 150. Yes.
Yes, miss.
So can you all tell me how is purchase consideration of 500,000 discharged?
100,000 is the cash given, and 250,000 shares of $1 each, and then there's a share premium on that. 150,000, so per share is 1.60.
Okay, so 250,000 ordinary shares are issued at 1.60. Now they want you to record the journal entry to purchase the business. So I want you to try this journal entry yourself. I have made you write the format of recording the journal entry. Now I want you to use that format and pass the journal entry to record the purchase of business. So the journal entry to record the purchase of business. Can you check it? All assets taken over 275, 37, 28, 37. All assets taken over debit, and you will leave one line. This one line is the difference between your NATO and purchase consideration, which would be your balancing figure. All liabilities taken over credit. Then what will be the discharge of purchase consideration? The discharge of purchase consideration would be cash and cash equivalent credit, share capital, share premium.
Miss, but then it says that, like if you read the first statement, it says that cash and cash equivalents are not entered in the journal.
Darling, the purchase consideration is discharged by payment of cash. This is
Okay.
that.
Okay, fine.
Okay. That is that cash and cash equivalent. So it's done.
Yes, Miss Done.
Yes, Miss.
So can you all now do this second part of it, where I just want you to pass the journal entry to record the purchase of Monty's business. Try it yourself. Pass the journal entry to record purchase of Monty's business.
It's not negative.
Purchase consideration is 460,000. And what is the NATO?
285,000.
Where is it given? NATO is 285,000.
You have to calculate it.
Okay, so the net assets that is taken over is how much? What is the assets that is taken over?
303. So 190 plus 55 plus all of them.
195 plus 55 plus 19 plus 26 plus 13.
303, not 313.
303. And what is the liabilities that is taken over?
18,000.
303. Liabilities taken over is 18,000. So what will be my NATO? 303 minus 18. So my NATO is 285,000. So the goodwill is how much? 460,000 minus 285,000. So my goodwill is how much? 175,000. Are you with me?
Yes, Miss.
Farha,
Yeah, Miss.
sure?
Yeah.
How is it
Very simple, Miss.
discharged? How is it discharged? 460,000 is discharged with cash 40,000. 300,000 ordinary shares. So what is the share premium?
$120,000.
So the share premium is 120,000. And if I have to find the amount of premium per share, then it would be 120,000 divided by 300,000. So it will be how much? $0.40 per share. Yes. Let's discuss the statement of financial position. Farha, can you
Yes.
discuss the statement of financial position with me?
Miss,
the
we have to add both the
statement of
firms, right?
Sorry.
We just have to add both the firms' assets and liabilities, right?
So immediately after acquisition, so do you have to show goodwill or you do not have to show goodwill?
We have to show goodwill.
You have to show goodwill. So you will have intangible asset. First is goodwill. What is the amount of goodwill you already calculated over here? 175. So intangible non-current assets would be first goodwill. Then you will write your tangible non-current assets. How will you write it? Come on. This is of whose business? Monty's business. So premises is 190. Plant and machinery is how much? 55. Office furniture is 19. This value I'm getting from here. Inventory is 26. Trade receivables is how much? 13. Did they tell us anything about cash and cash equivalent
No.
being taken?
They said,
I
I think they said it's not taken over.
Sorry.
They said
Just-
it's not taken over.
So it is not taken over from Monty's business. But what will you do for Bridges business? 69, because this is the limited company that is already existing, right? Are you with me?
Mm-hmm.
Okay, so 69 is the cash and cash equivalent that they already have. From this, they have discharged a purchase consideration of 40. So you would have to deduct the 40. With me?
Yeah.
Yes, miss.
Tangible non-current assets, I will just add these two for premises, land and building. Plant and machinery, I will add these two, 133 plus 55. Office furniture would be 19 plus 58. So I will get my total non-current assets. In the current assets, I will add these two for inventory, 33 plus 13 for trade receivables, and for cash and cash equivalent, there is nothing for Monty, but for Bridges it would be 69 minus 40 and 29. With me?
Yes, miss.
Non-current assets plus current assets will give you your total assets. Then you will have your equity and liabilities. In that, what will you write? You already had how many shares?
250.
No, darling. You already had how many shares?
Oh, 550, 550.
550. And how much you've given as purchase consideration?
300.
So 300 ordinary shares are given as purchase consideration. So in 550, you're going to add 300. So your new ordinary share capital would become 850. Are you with me?
Yes, miss.
miss.
Then share premium. What will you do? Old share premium was 155. What is the new share premium?
120.
120, are you sure?
Yeah.
Yeah.
Yeah, 120. So the share premium is 155 plus 120. How do you get 120? The total purchase consideration was 460,000. 40 was discharge in cash and 300,000 ordinary shares were issued.
275.
So you get that. Retained earnings, there was nothing that was given for retained earnings, so we just add that. So total equity and liabilities will become addition of these three. And current liabilities, trade payables. There is nothing that is mentioned over here. So this would will take 39 for bridges and 18 for Monty. So this would be our total capital and liabilities and the new statement of financial position.